Okay, this is our last online video session for the semester. We're going to tie everything together today with the fourth and final financial statement, which is the statement of cash flows. The entire purpose of this statement of cash flows is to let anyone looking at the company to know how is the company spending and or receiving their cash. Where is it coming from? Where is it going to? And the first thing when I think about cash, and probably a lot of you do, is you would say, well, we could look at the income statement to know how much cash we're bringing in through revenue and how much we're spending in expenses. And that's exactly right. That's a great place to start, is when we want to look at the income statement and visualize here with my little income statement of simply having my revenues and then listing a few expenses. That think of in my left hand, I am bringing in $10,000 of revenue. And then I'm paying out each of these expenses. So in supplies, I'm taking $2,000 out. Wages, another $4,000. So in total, I have thrown out $9,000, leaving only $1,000 left. So I think, well, I should probably have $1,000 in cash when I go to the balance sheet. But then when I do look at the balance sheet, it says, no, cash is $5,000. So the question then becomes, how in the world could I have $1,000 net income showing that I brought in 10, I paid out 9, I should have 1,000 left, but I have 5,000. Well, that's what this section, that's what this whole statement is here to tell us. Because there's lots of reasons why cash and net income may not equal, but net income is a great place to start. It does give me a good idea of how much I brought in sales, but we'll need to remember that just because I brought in sales revenue of $10,000, we got to remember that that doesn't guarantee that I brought it in via cash, because I can also count revenue if it's on account. Same with these guys. Just because I counted wages expense of $4,000 doesn't mean I actually paid wages of $4,000. That last pay cycle may have been a wage expense and then credited a wages payable as an adjusting entry, and then I'll pay them early next year. So all of these have some issues that could happen to affect my cash. Let's look at some examples to help maybe clear up why does my cash say 5 and my net income 1? Well, it's always a good idea, and this is how we're going to do it. You always start with net income. Net income doesn't tell us everything, but it is a really good starting place. Because what if, besides just what I have there, net income, this first transaction took place? I bought $4,000 of equipment with cash. So therefore, my debit would have been to equipment as an asset, and my credit would have been to cash, also an asset. Okay, so how did those two assets in that journal affect my income statement? Because remember, I showed $10,000 coming in, $9,000 being paid, leaving only $1,000 left. Where did this $4,000 equipment purchase show up over here as a $4,000 cash payment? And the answer is it doesn't. That $4,000 didn't appear anywhere. That's something that definitely affects cash, but it's not showing up in this number, or more specifically here, in this number, not 1,000 cash. So what I need to do is I need to start making, and this is the real short and dirty, the quick and dirty version of the statement of cash flows. We're going to do a more real version, the more professional version here in the second video. But the real quick and dirty version says, all right, let's start with our cash, with our net income to explain our cash. And then let's start explaining a few of the items that we have notes on that aren't necessarily driven by this $1,000 in cash. Well, the first thing is we spent $4,000 in equipment. That equipment purchase did not show up in the expenses. So I need to adjust my net income figure. So my statement of cash flows essentially in one of the sections would show a negative $4,000 being spent. cash being drawn out. So now I'm actually down. If I was just doing it, that one item, I would be at a negative cash, which obviously can't happen. But at this point, I would have a negative cash balance. All right, let's do the second one. Depreciation expense. If you think about what the journal entry would be with depreciation, any depreciation, you would have a debit of depreciation expense and a credit of accumulated depreciation, not cash. So go back up to my income statement. Depreciation expense is acting like I spent money, just like if I spent $4,000 in wages. But I did not spend any money on that depreciation. Nobody got $2,000. That is simply showing that I had used the equipment to that value. So I need to pretend, if I'm thinking about it with the statement of cash flows in mind, cash related, I got to pretend that that depreciation isn't even there. So to pretend it's not there, I need to add it back. I need to pretend it never occurred and brought me down to 1,000. Because without it, I would have been at 3,000. So with that depreciation, I need to add that 2,000 back to my starting number as an adjustment. There's no journal entries to make here. These are like any other financial statements. When we do financial statements, we don't make other journal entries. These entries have already been done. Number 3, if we sold $9,000 of stock for cash, just like what we did this last week, well, we would have debited cash and then credited in some form or fashion our common stock and our additional paid-in capital to common stock. Neither of those items, especially the common stock, it doesn't show up over here in my income statement. Revenue is not common stock. Common stock is its own owner's equity account. So that $9,000 coming in didn't show up anywhere. So I need to pretend that this net income, what if it did have that $9,000? I need to make an adjustment down here on my statement of cash flow, the real brief version. I need to show that I received $9,000, and that's going to help explain where all my cash came from. Now the fourth item here, AR balance. That should be started, that's stared. Started at 4,000 and ended at 7,000. Okay, so if I'm thinking of a T account and I had a beginning balance of 4, and then at the very bottom I drew a line and had a total of 7, well, that means my account receivable went up. And the most logical reason why account receivable would go up 95% of the time would be because I sold something and I sold it on credit for my customer. So if my account receivable went up by 3,000, that means that of this 10,000 in revenue, only 7,000 came in via cash. So when I thought I had 10,000 coming in as cash, that's not accurate, really, by looking at the AR. Because AR went up 3,000, I really didn't get all the cash that I thought. So I need to make an adjustment. It's not that I really lost cash, but if I have this $1,000 based on an assumption that there's 10,000 cash coming in, well, there's really not. So I need to take away 3,000 as an adjustment. Because cash was not collected, but it was counted in my revenue. All right, let's look at this next note. If I purchased $1,000 of land on a note, well, I would have debited my land, and I would have credited my note payable. Land was an asset. Notes payable is a liability. Nowhere does that $10,000 purchase of land show up in my income statement. But that's a good thing in this case, because nowhere did I actually spend cash. So if I didn't spend any cash, and it doesn't look like anywhere over here that I spent $10,000 in cash, then this would be something that I do not have to do anything with on the statement of cash flows. This $1,000 is still accurate. I don't need to adjust it for that transaction. And then think about this last item I have. Paid $5,000 on advertising with cash. Well, here I show advertising expense of $1,000. If I spent $500 of that with cash, then I don't need to adjust anything because it looks like I spent at least $500. There was probably this. Let's actually make this 1,000. This should be 1,000, just to prove everything. It wouldn't have to be. I could have just had a journal entry that said 500, and that would have been fine. But if I wanted to go ahead and explain all of it, and I said I spent 1,000 paying for advertising, and I used cash. Well, this makes it look like I spent money, and therefore bringing my net income down. But did I really spend money on that 1,000 on advertising? Yes, I did. So my net income, that $1,000 for that transaction, is correct. No adjustment needed. So if I go back to my partial income statement now, or my partial statement of cash flows, if I start out with 1,000 and then subtract out or add in the following 4 items, well, when you do that, you actually come up with a total balance of 5,000, which explains my balance sheet cash. So using the 1,000 starting point, I was able to explain through the 4 things that needed to be adjusted where that 5,000 actually came from. So now an easy way to determine if something should go on the statement of cash flows like the first 4 did, or if something should not go on there like the last 2, there are 2 questions that you're going to need to ask yourself. And you should have these questions written down before coming to class, because we're going to go through this pretty quickly in class to start in on some exercises. The 2 questions you need to ask yourself: A, does the transaction involve net income? And if to involve net income, that means it needs to be a wage, it needs to be an expense, or a revenue account. If it's not a revenue or an expense account, it doesn't involve net income. And the other question you want to ask, does the transaction involve cash? Then once you answer those questions and you get a yes or no, we can then know if the item transaction should go to the statement of cash flows. If you answer yes to just one of those 2, so it doesn't matter which one, just one of them, then the item transaction does go to the statement of cash flows. You need to adjust that beginning net income figure. If you answered yes to both or neither, then your transaction does not need to go to the statement of cash flows. Net income did accurately portray what happened to cash. So let's put it to the test with our items just above, with our little examples. Bought 4,000 equipment with cash. All right, first question. Did the transaction involve net income? No, remember we had an asset, buying equipment, paying with cash, which is another asset. Did not involve net income. Did it involve cash? And the answer is yes, it did. So if the answer is yes to only one item, then this would go on the statement of cash flows, just like how we put it here. All right, let's look at number 2, depreciation expense. If there was a depreciation expense, our credit would have been to accumulated depreciation. So did the transaction involve net income? The answer is yes. Depreciation expense, that's an expense. That goes on the income statement. Did the transaction involve cash? And the answer is no, it didn't. So again, we had one yes and one no. So the transaction should go on the statement of cash flows, and it does. Now you can go through 3 and 4, but let's skip through to number 5. Purchased land on a note. Remember we had a debit for land and a credit for a note payable. Did that transaction involve net income? Nope. Neither land or note payables are part of revenue or expenses. And neither land nor note payable involves cash. So the answer is no to both of them. So we'd come down here to the second one. The transaction should not go on the statement of cash flows. There wasn't any cash spent, and the net income didn't make it look like any cash was spent. So there's nothing to adjust. The 1,000 starting point was sufficient. Or what about the spent 1,000 on advertising paying cash? Well, we would have had a debit to advertising expense and a credit to cash. Does advertising expense fall on the income statement? Yep, sure does. Did this transaction involve cash? Yep, it did. So we answered yes to both of them. Therefore, the does not go on the statement of cash flows because the income statement makes it look like I spent money, and I really did spend the money. So there's nothing to adjust. All right, now, the three things that you have to do a statement of cash flows. Well, you have to have the beginning and ending balances on your balance sheet. Therefore, to have beginning balances, usually you just start with last year's ending balances. So that's why I put there the last 2 years. You need the last year and this year's balance sheet account numbers to know if certain accounts, like your account receivable or your account payable, or all of the accounts we want to look at to see if they went up or down. And then if they went up or down, we're going to need to affect the statement of cash flows, perhaps. And we'll explain that in just a second. We're going to need this year's income statement. Of course, we have this year's income statement because A, I need to know what the net income is. And B, I need to see there are two items that go on the income statement that never, ever involve cash. We've already discussed one of them, and that was the depreciation expense. Whenever I have depreciation expense, it does not involve cash in any way. The other one that we're going to look at later is any gain or losses. Gain or losses do not involve cash either, but yet they do affect my net income. They make it go up or down. But in no way was cash affected by that amount of net income, of net loss or gain. We are going to be looking at the indirect method of the statement of cash flows, just so there's no confusion. The direct method, you can do that on your own if you'd like, but we are just going to have time to discuss the indirect method. So now what we're going to be doing here is a much more proper way of how a statement of cash flow will really look. And then in the second part 2 of this video, we're actually going to do an actual example of a statement of cash flow. So with the statement of cash flows, there are 3 sections, just like with the balance sheet. The balance sheet has 3 sections: the assets, liabilities, and owner's equity. This one has 3 too. The first one being the operating activities. The operating, that's maybe the most crucial part of the statement of cash flows, because that tells how the business is doing on a day-to-day basis. It's telling you if on a day-to-day basis if you're getting and receiving more cash than you're actually paying out, which hopefully you are. Remember what I had said at the very beginning. We always start with net income. It's a good starting point to see how much cash we're bringing in versus paying out. And then once we have, under the operating section, once we have the net income down, then we look for those 2 income statement items that never, ever affect cash. We'll look at the depreciation expense. Whatever it shows on the income statement for depreciation expense, well, I want to pretend that it never happened because I didn't pay that money. I want to add that cash back in. I need to make an adjustment. Just like what I did up above when I had depreciation in my little example, I added that money back to the net income. And then I want to do the same for any gain or losses. Losses are going to be just like any other expenses, just like depreciation would be. Losses make your net income go down. but in no way did you actually lose more money. A loss is just a comparison between how much you brought in versus the book value you had left on your asset. In no way does it say that you lost an additional, say, $6,000. You may have had a loss of $6,000, but you didn't lose extra cash. So if you have a loss, we're going to add it back, just like we do with the depreciation expense. We're going to pretend it wasn't there. Just the opposite is a gain. We need to subtract the cash, because a gain is going to make our net income go up, but we didn't get extra money just because we have a gain on our books. Once we have those two income statement items dealt with, then we need to do the final piece of the operating section. And that final piece is looking at any current assets and any current liabilities. All current assets are going to be the same. And then notice my one little exception here. We deal with all current assets except the biggie, cash. We're going to do cash at the very, very end, because that's the whole purpose of this. We're going to do all our current assets, and they're all treated the same. Remember in my previous example, the account receivable went down, or actually went up $3,000. If you have a current asset, like accounts receivable, that goes up, and then this one went up. We went from $4,000 to $7,000. What that means is you need to make a negative adjustment. Because remember, if your account receivable goes up, you collected less cash. Your revenue looked like you collected more, but you really didn't. So in our example, we collected $3,000. Our AR went up $3,000. Therefore, we had to make a negative adjustment to cash. But just the opposite. If my AR goes down from, say, $5,000 to $2,000, well, most likely, 95% of the time, that means I collected money. That doesn't show up on my statement of cash flows that I collected that extra money from my account receivable. So if AR went down for the year, I need to add that amount of cash in because I got extra cash. We're going to use the same little cheat sheet formula here for any other current asset. So anything like inventory or prepaid accounts. And then we need to look at our final little piece of the operating section is our current liabilities. Take, for example, our accounts payable. If accounts payable went from $2,000 to $3,000, it went up. If accounts payable went up, well, the reason why an account payable would go up is usually I expense something. Maybe I had, let's say I put advertising on account. So I would have debited advertising expense if I used it right away. And then I'm going to pay the advertising company later. So that account payable went up by $1,000. I didn't spend the money. But if I looked at my income statement and I saw that $1,000 there, it makes it look like I did. But I really haven't spent the money yet. So if your accounts payable goes up, it's kind of like we need to with the depreciation. We need to add the cash back in because that expense didn't involve cash. Even though our income statement made it look like it involved cash. And then just the opposite, any current liabilities that go down, say your note payable went from $40,000 down to $30,000. Well, 95% of the time, the reason why it went down is because you made a payment. If you made a payment, you spent cash, and you need to show that cash has been decreased. Okay, our second section, and these are much shorter sections. Not necessarily any easier, but they're shorter. With these sections, we actually will want to provide journal entries from the notes that are given in any particular example. Whenever you have the investing section, first off, is going to deal with only long-term assets. So only your PPE items. If you are buying and selling any assets, they're going to show up on here if cash was involved. Because remember, if it's on account, if you bought the whole thing on account, it doesn't need to go on here because you didn't spend any cash and the income statement doesn't show that you bought any equipment, obviously. If we look at our balance sheet and our equipment went from $40,000 to $60,000, it looks like I spent $20,000 in cash to buy that equipment, but not necessarily. This is where we're going to have to look at the notes, and I'll explain that in the second video. But we're going to look at our notes to see how exactly did I purchase that equipment. Or if I absolutely need to, I'm going to need to go back to the journal entries to see how was that piece of equipment purchased. If I bought the whole thing with cash, well, then I need to say that I lost $20,000. If I split it 50-50, paid half down, half later, well, I need to show that even though the equipment changed by $20,000, I only record what happened with cash. Cash, I only spent $10,000 at this time. So that's what I'm going to show as a cash adjustment. Remember, this only reflects what happened to cash. The same thing with a sale. If I sell an asset and I brought it and all of it was sold for cash, then whatever I sold it for, that's what I'm going to bring in and adjust here on my cash. But if I only brought in half the purchase price up front, what if I brought in nothing? It was all on account. They're going to pay me it all later. If I sold equipment all on account, then nothing would go on here because it didn't involve cash, and the income statement has no idea that I sold the equipment because there's nothing on there that says you are going to be getting more money. The final section before we do the summary with our cash is the financing, and this is all the rest of the accounts on the balance sheet. So we've already done in the operating the current assets and the current liabilities. We've also just did the long-term assets. The only thing left are the long-term liabilities and the owner's equity. And the only account in this whole owner's equity item that we're not going to use is retained earnings. I'll be able to explain more why we're not using retained earnings in class, but the short answer is because whatever's in retained earnings, we are going to have used elsewhere. Because remember, the major component of retained earnings is net income. To get retained earnings, you close out your revenue and your expenses. Well, I've already got net income up on the operating. And then the other aspect of retained earnings is your dividends. And as you're going to see in this section here, we're going to take care of dividends in its own place. So we don't use retained earnings because retained earning, the change amounts were already used elsewhere in the statement of cash flows. As you'll see with the financing activities, anything that happens is treated just like a current liability up above. Therefore, if I have something, say an increase in owner's equity, say I sold some stock, then my overall stock value with top par plus the additional paid-in capital, let's say my overall stock value went up $15,000. And if I had a little note down at the bottom that says all the stock was sold for cash, well, my journal entry would have said something to the effect, debit cash for 15, and then credit my 2 stock accounts. Well, neither of those stock accounts affect net income, but the transaction did involve cash, so that's why it would go on the statement of cash flows. The net income doesn't know that I got extra $15,000, but I did, and therefore I need to show that I got the money. I need to add that in as an adjustment to my net income figure. Just the same, if I paid off, say, my note payable, which is a long-term liability, if I pay it off, I'm going to reduce the cash by the amount that I paid on the note. And then just like paying on a note, if I pay out dividends, I'm going to want to show that. Just because I have a dividend payment doesn't mean it shows up on the income statement. Dividend payments aren't a revenue or an expense. That's an owner's equity item. So I need to account for that, make an adjustment to show how much I spent. the final piece, to wrap everything up. Like in the balance sheet, when you wrap everything up, when you have a total line item of liabilities plus owner's equity, and then you match that to your total assets, kind of the same thing going on here, in that we're going to have one final number to use as our check figure. So what we do is we take, well, what was the cash at the end of last year or the beginning of this year? And then we add in the three sections that we just calculated: the financing, the investing, and then the operating. We add up those three numbers together. Whether it be a positive or a negative, doesn't matter. We're going to combine the two numbers, the beginning and the changes, and then get one final amount. That final amount, if you did everything right, should be the same as your ending cash balance in your T accounts. All right, now we're going to put all this together and do an exercise in our next video. So you'll need to follow along because I do want you to have this exercise completed by the start of class. And we will finish off here.